right now.
Let's break all the action down today. And by the way, a lot of action coming with all those earnings coming out. Tom Lydon from ETF Trends, he's going to tell you why he's looking to buy outside the U.S., but that's a broad statement, Tom. You're going to have to drill down on that. Alan Bond from Jensen Quality Growth Fund. Alan will tell us if he thinks this bull market still has room to run. And Bob Iacchino in the pits of the CME. Let us begin with you, Bob. There is a question among a lot of investors right now, smart ones, whether a record at this point is a good thing with such thin volume. How do the traders at the CME see this?
Honestly, other than the money we're making on being long, we don't really like it. From a macro perspective, in terms of the structure of the market, it's not a massive volume record. And also, in anticipating the Fed rate hike, which I am, I think you kind of want to see a dip before that. Historically, a dip before a Fed rate hike has caused the market within the 3 months after to go up on an average of about 1.3% prior to the rate hike. So I think we're going to need that dip. You average about a 5 to 6% correction before the first rate hike. A lot of things are different right now, but I think these records are showing that the market believes the Fed has pushed their rate hike back way into 2016, and I just don't agree with that.
All right, Tom Lydon, you think the dollar is going to be getting stronger. Now, I know that affects your belief in some of the European stocks, which you can talk about, but very, very simply, if you can, we're not talking to monetarists here, very simply explain why a stronger dollar and how it should affect my investments.
Well, as we talked about, there is a Fed rate hike coming. We just don't know when that's going to be. But also, David, we've got a QE package that's huge. It's going on in Europe right now as well. Both are working to have a stronger dollar, lower foreign currency in Europe.
Tom, can I stop you right there for one quick second?
Sure.
I told you we had numbers, and we do. We begin with Gap. The earnings are out. Cheryl.
We are getting Gap right now. Liz, it's interesting because we got it actually for 56 cents. We got a meet on the earnings per share, which is very interesting. The revenue, though, coming a little bit shy, and you're going to love the reason. $3.66 billion is the actual reported revenue for the company. Analysts expected $3.76 billion. They really had a negative impact from the Westport shutdown. That was the big problem for them. You know, we were looking for different things like currency conversions and things. Also, they're telling us that it looks like as far as sales were under pressure about 3% or so. They had reported that already. They are confirming that. And they actually comparable sales year over year down 4%. The year over year number is down 4%. So sales were hurt. That is the consumer. But the West Coast port shutdown hurting Gap in the quarter. Liz and Dave, back
Cheryl,
to you.
thank you. Tom, let you finish your thought there.
Yeah, well, Liz, the idea here is we just had a 9% correction in the dollar, which is the opportunity I think most should take advantage of. And most importantly, with equities moving in Europe, and a lot of people feel that domestically we might be a little bit long in the tooth. With the QE program really kicking in, and most importantly, taking advantage of the currency hedging that's available in two particular ETFs, the DBX Tracker European Hedge Currency, and also the Wisdom Tree European Hedge Currency. Both great opportunities, and again, compared to U.S. opportunities, I think we're really fresh.
Hey, Alan, the economy plays on all of us. We're concerned about it on Main Street. We're also concerned about it with regard to earnings. You expect it to stay kind of on the weak side, don't you?
Well, that's a good point. Yeah, you know, we look at the market this year, and we're off to, you know, kind of a slow start so far. We think a lot of that's economically driven. The market here domestically is certainly off to a slow start. We think it can pick up later in the year. We're looking for signs of that right now. And then, like we were talking about earlier, the economies overseas are a little weak. We see dovish monetary policy helping prop up stock returns there. You know, I think for us, how does that impact our strategy? You know, we're really very much bottom-up focused, looking for businesses that can really thrive in any economic or monetary policy or currency environment, and that continues to be our focus.
That's the focus there. But when you're starting to pick some of the names, is there something that you're avoiding in particular?
Well, we try to find names in companies first that have competitive advantages, produce stable free cash flow, and are businesses that are resilient throughout a full economic cycle. So that lends us or leads us towards high quality businesses, businesses that we think can grow and create business value over time. So what we avoid with that are businesses that are more susceptible to commodities, where pricing power isn't as strong, or where competitive differentiation might be weaker.
Hey, Bob, let's talk about oil. It rallied today. It's over 60 bucks a barrel again, but you know how that goes. One day up, the next day down. You think that the crude rally's just about played out, don't you? Why?
It is just about played out, and that's not to say that it doesn't have a little bit more to go. I think you're probably going to see 63.20. I know it's a very specific price, but I have a reason for that price. But having said that, what's happening right now is the shale producers are showing us where they make money. There's been a 20 to 30% decline in servicing prices from the drillers. They've actually had a discount in their pricing models. When you take that and you combine it with, we're actually seeing production shrink, but the rig count fall is really slowing. You only had a slow of about 4 rigs this past Friday. They're starting to turn on some of the other rigs, and companies like Occidental, Conoco have actually raised guidance for production going forward. So I think the shale producers are showing us where it makes sense, and it seems to be somewhere in the 60s. If you get a sustained price here, they're going to turn it back on. Oil's going back down.
Tom Lydon, when you talk about whether it's energy or anything else, there are all kinds of headwinds and tailwinds here in the United States. But if you are, as you say, going overseas, what is it about Europe at this point where you'd say, let me go into an ETF? How focused should that ETF be on certain areas that might at least duck away from some of the problems that are still very much alive in Europe?
Well, when you think about problems in Europe, I think everybody focuses on Greece, Liz. But when you really drill down, Greece is going to have very little impact on the overall economic movement. So I think that's something that we need to get past, just like we're having to get past a Fed rate hike here in the U.S. Okay. With ETFs, we have the diversification and certain strategies, like Wisdom Tree goes after earnings.
Hey, Tom, you drew the short straw today, I'm afraid, because we got earnings on Hewlett Packard coming in again. We gotta disturb you. Go ahead, Cheryl.
Okay,
what are the numbers?
Certainly my apologies there, but I do want to give you Hewlett Packard numbers. The adjusted earnings per share is coming in at 87 cents. We were expecting 85, so that's a beat of 2 cents. Looking at the revenue, though, a little bit of a miss. The revenue, the expectation was for $25.63 billion, coming in at $25.5 billion. So a little bit of a miss. Couple of things here. Foreign exchange rates, again, currency, and Gap later on in their release told us the same thing was an issue. Also, they're naming the CFOs of each of the companies, and they're saying that that split of the company is actually on track right now. So they're giving us a few more kind of details, but the separation remains on track. The company expects everything to kind of stay financially synergy-wise to be a good thing, and so that's good. Really quick, though, I should say the stock was up about 2%. It's up about 1% right now, but HP moving a little bit higher on those numbers.
Well, 2% today, 1% after hours. That's a 3% gain. That's not bad, Liz.
Yeah, and they have a new chief financial officer, Tim Stonecipher. So,
all right.
Thank you.
Tom, we got it. I promise next time we invite you back, it won't be during earnings, so we'll give you a full sentence. Tom Lydon, Alan Baum.
Great talking with you, folks.
Bob Iacchino, thank you all very much.